Welcome to a special Tuesday edition of Market Monday from the investment team and the trust department at the First National Bank. Like usual, we plan to review the economic numbers that are coming over the next couple of weeks. We'll talk about the equities markets and the rates markets, and then get into some of the drivers, which include artificial intelligence and demand for semiconductors, the issues and the conflicts going on over in the Persian Gulf, and inflation, which we'll cover briefly up front, but in more depth later. Starting things off, we got some information about payrolls recently that suggested that the labor market could be weakening, although that was kind of a one-off situation. Yes, the prior non-farm payrolls number was released and revised down, and the new one came out with a net loss of jobs in the economy over the month. So with that said, we do have to kind of wait and see whether a trend develops there. And markets largely just kind of absorbed that and continued to trade near all-time highs. We get tomorrow CPI, the Consumer Price Index, which, although it came in on the headline number with negative 0.4% last time, is expected to show a 0.1% rise by most economists, or at least the average economist's expectation. And then the core number is expected to go up by 0.2%. And core strips out food and energy, although food and energy, are things that the everyday consumer is presumably buying in a decent quantity. So we're not so sure how helpful it is to look at core, even though it does smooth the data out. Food and energy prices tend to be volatile, which is why they are smoothed out. But the year-over-year number is expected to be 3.4%. So while that's coming down from 3.5%, that is still a very hot number relative to the 2% that general economics principles suggest is a sustainable inflation and a healthy inflation level for our economy. And so the Fed has decided to stop issuing as much guidance about its thoughts and its plans to the marketplace in its press releases and conferences. So what are we to make of it? Well, we think that this is going to make things a little bit more volatile because market participants don't have as clear of a read as to what the Fed is going to do about this. Are they going to let rates in inflation continue to rise, or are they going to do something, about it? Either of which creates, both opportunities and risk in the market. So market participants are notably a little bit more jittery. Volatility gauges particularly in the treasury markets have gone up, particularly at the longer end. And we'll talk about that later when we talk about rates. But we're going to get more labor market data. We'll get producer prices. And here's a key thing. When we're looking at producer prices that are expected to be going up at the headline number by 0.2%, but the headline CPI for consumers is going up by 0.1%, that suggests that companies are seeing their input costs rise by the 0.2%, but only able to pass along half of that cost increase. The natural conclusion that you have to make is that corporate margins are likely shrinking as a result of that relationship being in that configuration. So that would not be great for earnings season if that situation persists. And we'll be interested to see if these numbers actually come out near their expectation. So moving down, we get retail sales. That's a huge number because, consumers are about 2/3 of economic growth, GDP, and that's expected to show a decline. At least when you still have cars and you still have gas in there. But we're looking at potentially weakening demand if the expectations are right, a potentially weakening labor market, which we've already gotten a read on, and then sentiment indicators, which also appear to be expected to be lower. So this suggests that overall, economists are seeing a slightly weakening economy at this point, and that bears watching, especially with equities trading at all-time highs. These are configurations that generally could lead to disorderly markets later in the year if these conditions continue and or accelerate that direction. Particularly if the expectations keep going in that direction, we want to be on the lookout for volatility. But we'll get some labor market, big industrial production numbers, that's expected to show growth, more outlook, and the leading indicator index, which nobody's gone on the record yet, or at least not enough participants have gone on the record for a forecast yet. Rounding that out, though, All of this has taken on kind of a backseat to things that are transpiring in the Persian Gulf, which we'll get to later. So let's move into stocks. And the S&P 500 obviously is trading right on all-time highs. And this has been driven largely by the artificial intelligence boom, which despite quite a blowout in that area, a 20% correction that happened just within the last month and a half or so, is seemingly back to the green. And we've got these stocks trading at all-time highs. Sentiment seems to be very good. There's an old saying, the animal spirits are out, and that suggests that there's bullishness all over Wall Street. And we can see that here. It's reflected here. This type of a solid basing pattern that's broken out, could lead to another leg up in the market. So we're watching that. I mean, while we see lots of risks, you don't ever want to fight the market. And at the same time, we don't want to clamor to be adding to our stock positions at all-time highs just because they're there. We need to follow a decent, well thought out plan. And we'll come back to that later. Volatility. This is the VIX Volatility Index, and essentially it distills actions in the options market that into expectations of how much market movement is expected over the next month. And so this level of 15 is relatively low, although it's been above 15 for the most of the past year, and that's actually a level that's relatively elevated, suggests moderate risk in the market. There's a notable feature to this chart. It tends to, when it gets very volatile, this number spikes very rapidly. And so it usually spikes from down in this area as well. So we're not so confident that we're out of the woods just because this number is low. There are a lot of other events, exogenous factors that could be catalysts that could move the market rapidly. So we're going to keep watching. Complacency is not an option. And then there's the longer term, but I'm going to come back to that at the end. Here is the Treasury yield curve, and we've done this in two different views so that we can kind of gain an appreciation for what's happening with rates and what's happening with inflation expectations. So this gold line here is what the yield curve was the day before we began all of the festivities over in the Persian Gulf. And you can see that yields have gone up, particularly in the belly of the curve, very substantially, and across the curve, really. And that's because, energy prices are spiking, and not just energy, but prices in general, because the cost of shipping goods is up. The supply of a lot of goods is shorter because we can't get a lot of shipping through that Strait of Hormuz or some of the other straits in that area, some of the other waterways. So, while the conflict goes on, and we foresee this conflict going on indefinitely, we're going to be in a higher rate environment. Look at this. The 2-year paper is up 85 basis points since February, 90 basis points on 5-year paper. And it's only out further in the curve that it starts to come down. And it's saying what I would read from this is that bond investors seem to think that this is a longer term thing going out maybe, more than 5 years, that we're going to see prices like this, inflation like this. And now let's take another look and see what's happened since the new Fed chair was installed, since the last press conference, the June one, or the first press conference, I'm sorry. And you can see that this idea that's been flouted as, they're going to give less guidance and let the market work it out. Well, the market's working it out, and the market seems to think that these policies are inflationary. As you look out the longer end of the curve, that's gone up. 10-year paper's up 24 basis points in yield, 30 years up 34. That suggests that long-term bond investors see a long-term period of elevated inflation. And that's not exactly a vote of confidence in the market, because bond prices are inversely related to yield. So for this to happen, bonds have been selling off. In other words, fixed income investors don't want to have as much duration exposure, which just simply means, how long to maturity these bonds are and how long inflation has to kind of eat into their interest payments and their principal. Moving into corporate bonds, that yield curve is up substantially since February as well. 83 basis points in the 5-year. The 10-year is up 72 basis points. And again, these numbers aren't quite as bad as the government yield curve, which suggests that despite the fact that financing conditions are going to be difficult for corporations, despite the fact that competitive conditions are more difficult for corporations, corporate credit risk seems to be on the decline, because while over here in the treasury markets, the pricing factor is inflation and really inflation alone, over here, there's also a default risk premium that goes into the yield. And if the yield for bonds in the corporate world, high quality, are going, up by a lower rate than they're going up in the government bonds, that suggests a narrowing of the credit spread, and that's embedded in there, or a shrinking of the credit spread, the default risk premium, it's called. So we're going to see what happens. Right now, there's a lot of buoyancy on Wall Street, but this thing in Iran has been going on for quite a while, and there's constantly flip-flop in the news and media, and coming from Washington and coming from Tehran and coming from all of the different intermediaries that are trying to get a deal done over there, that a deal is imminent, and then it's not. And then there are new demands on each side. And, then there's renewed fighting for a while, and then there's a period of more negotiations and renewed fighting. And we think that this situation is likely to persist for the foreseeable future. Is that a bad thing necessarily? I mean, not necessarily. The market doesn't seem to think so. The market seems to have adjusted pretty well. But, at a point, if consumer spending slows down, if the labor market decays, we could enter a relatively rough period in the fall. And, we are entering that September-October period where volatility is historically more likely. So we're kind of on the lookout for it. Looking over the long term, though, all of this stuff, there's a lot of bad news out there in the market. As you know, you've heard the old adage, climbs a wall of worry. We have plenty to worry about. Markets are trading at all-time highs. We would expect that to continue in the absence of some catalyst. But that doesn't mean we're going to buy indiscriminately and we want to go all in on the tech stocks, which essentially the S&P 500 has become a tech index. We just want to have a well-thought-out investment plan that's designed to achieve our goals, not designed to achieve market exposure. Those are two distinct things. As an investor, your goal is not to match the S&P 500. Your goal is to achieve your financial goals with the minimum of risk. So that's a disciplined approach. And, here we've got a logarithmic chart all the way back 20 years. And you can see here is 2008. We had some minor hiccups when there was a European debt crisis, sovereign debt crisis. We had some other hiccups. Obviously, here we had 2020. This is when the entire world shut down. And then this was a bear market in 2022, a relative scare last year. And we see these volatile points. Now, the logarithmic chart removes the bias from the index being at higher and higher prices and makes it visually look impactful to the degree that the event was actually impactful. It's not perfect, but it does give a better visualization of how bad these events were. So you can see the worst of these was actually here. And having lived through this, working on a trading desk, I can tell you, we all kind of thought the whole financial system as we knew it was ending at that time. Of course, it didn't. We don't want to be, as an investor, coming back to portfolio construction, we don't want to be selling into these panics. So if volatility comes in the fall, we want to continue to hold fast. And at the same point, we don't want to be buying into these big bullish extensions and indiscriminately in violation of our risk control, because ultimately it's not what you make that's going to cause the achievement of your financial goals. It's what you keep. So we want to make sure we're making smart decisions. And, if you've got questions about your portfolio, if you've got questions about the economic or geopolitical environment and how that impacts your plans, feel free to reach out to us. We love talking about this stuff. Hope you found the video useful. Thanks and have a great day.